And guys, Joel Franklin, market analyst for YouTrading, and in today's educational video, we're going to be talking about how a hawkish Fed can affect markets. So let's jump straight into the video, guys. We had the Fed's policy decision earlier this week on Wednesday, and pretty much they raised interest rates by 75 basis points as expected, a fourth successive 75 basis point rate hike. The federal funds target range is now 3.75% to 4%. But the hawkish surprise really came in the tone of Fed Chair Powell's comments during the press conference. He pushed back very, very strongly against the idea of a pause in, or like a near-term pause in Fed interest rate hikes, and pretty much sort of underlined the idea that the Fed still has a lot of work when it comes to lifting interest rates, as it tries to tame inflation in the US economy, which is still running well above the Fed's target. I mean, you've got core CPI like above 6% still, and you still got a labour market that's very, very strong. That was pretty much the message, and markets saw a hawkish reaction. So, what is that? What does it look like when markets see a hawkish reaction? Well, one of the first features is you would tend to see interest rates across the US government bond yields across the curve rising, and that certainly was the case on Wednesday. Let me just bring up a chart actually to show you. We can show you the 2 year, the US O2Y. If I zoom out a little bit, you can see that after this initial drop, after Wednesday's Fed meeting, we then had an aggressive rally, taking these 2 year yields, which are the most sensitive to Fed interest rate expectations, to fresh multi-decade highs. Like, you have to zoom out. In fact, I think you might have to go on like a monthly chart before I can see the last time we were this high. Yeah, the last time 2 year yields were this high was back in 2007. So we saw that spike in yields across the curve. You can also see it in the 10 year a little bit, although it wasn't quite as extreme. But we have rallied still in the 10 year. And then when US yields rally, you also see a rally in the US dollar, not just because of the flows of money back into the US to take advantage of those higher yields, but also for other factors such as demand for safe haven assets. Okay, because when the Fed's raising interest rates aggressively, that adds to downside risk to the global economy. The US dollar is seen as a safe haven currency. So, that's another reason why the US dollar would rally on a hawkish Fed. And sort of in fitting with the rally of the safe haven dollar is downside in stocks. You typically see stocks selling off when you get a more hawkish than expected Fed, when you see interest rates rising as a result of that. Why is that? Well, some of the stuff I'm already saying. Interest rates are higher, which puts pressure on equity multiples, because when you're looking at these discounted future cash flow models that people value their equities with, well, an important part of that is expectations for future interest rates. And when expectations for future interest rates rise, that reduces that valuation multiple. So that's one alley that affects stock prices. But another way it affects stock prices is through expectations for weaker earnings growth. Because, if the Fed's aggressively hiking and they cause a recession as a result, then, that's not good for company bottom lines. So that is why we saw the S&P 500 come under some pretty heavy selling pressure in wake of this week's Fed meeting. Of course, when you get a dovish Fed, you would expect to potentially see the opposite reaction, which is actually what we did see in first. Let me just zoom out. When they first announced their interest rate hike, there was a slight dovish market reaction. We saw the dollar selling. We saw stocks initially rallying. Obviously, Fed Chair Powell ruined the party pretty quickly. But that is sort of a bit of a preview as to what would happen if there was a dovish surprise from the Fed. But anyway, guys, I hope this video shed some light about how the Fed can affect markets. Hope you all enjoyed it, and I will see you all in the next one.